Good day, fellow investors. In a recent video where we discussed the S&P 500 25 stocks, and my conclusion was that those stocks are extremely overvalued or not attractive from a risk and reward perspective. And there were many comments about my strategy, what I do. Basically, you try to time the bottom instead of buying at a discount. And in this video, I really want to discuss this comment and also another comment where I'm not looking for whether a stock could outperform the market. And that's something that I really want to add value to because my strategy is completely different than 99% of the market. My strategy works for me, and the key when it comes to investing is that you find out what is your strategy. I'll give you three things that I think give me an advantage towards everyone else and makes me very happy when I get these comments where people disagree with me. Because only if people disagree with me, then I can have an advantage. For the last 5 years on my research platform recorded, I've done 15% per year. In the past, even better for myself, and I'll try to keep doing that for myself. Therefore, yes, most people have to disagree with me. In this video, I'll give you three things, and then at the end, you'll see whether you agree with me or not. At the end, even Warren Buffett says it's something you either have it or not. You cannot learn it, or it's very hard. So let's start with number one. Buying at the bottom at buying at the discount implies in both strategies a relation to the market. When it comes to investing, I don't want to depend on the market, and that's key. If you invest, if you're an investor, you don't care what the market will do in the future. You don't bet, oh, the market will do this, I'll make money here, this is undervalued, should be valued like this. No, you invest in fundamentals. And those comments are completely correct. And that's what makes me proud about what I do because, okay, I do this, people don't like it, that's the right strategy. Discussing that, what's investing for most, Wall Street and others? For most people is, okay, Starbucks is overvalued, undervalued, this is now a buy, sell this, buy this, average down on this. And everyone is investing into anything. Anything can be a good investment depending on where it is in relation to the market. And all you want to do is to beat the market constantly year after year. By competing into that game, you're actually taking too much risk, in my opinion. Because you assume the markets are efficient, P/E ratio of the S&P 500 of 24 is okay for Wall Street. Just looked at BlackRock, 9 trillion of assets under management invested everywhere. And for them, that's okay. Okay? For them. For me, not so fast. Just look at the price earnings ratio of the S&P 500. 24, while the historical is 15. So this is, for me, a huge difference. We are now here. Historically, average is here. And then there is also the bargain territory here. From here to here, it is minus 70%. If that happens once in your lifetime, that will be a huge hit to your portfolio investing, whatever. So, my first advantage when it comes to investing, I do not have to play this game. I do not have to play at a P ratio of 24. I don't like the rules of that game, so I can simply step away. There is no one forcing me to invest. If, of course, if I would have 9 trillion of clients, everyone is there, oh, make me money, make me money. I don't have to. I can play my own game here. And if I find something here, it's hard to find it, but if you do research, you can find it. Now I have 3 stocks in my portfolio, one from Asia, one listed in the United States, one from Europe, so a little bit for everyone. And they're all in this territory. Completely different than this game. So in life, you get what you focus on, and I do not have or do not want to play your game. So your comments are completely correct. I do not have to follow you. That's the first advantage I have, because the S&P 500 is overvalued in my opinion, and I'm not trying to time the bottom there. I'm just trying to assess where would this be valuable for me. Timing the bottom, no. Buying at a discount compared to the market, that's not what I care about. And yes, if you look at Starbucks stock here, it was likely undervalued compared to the market. Now it is fairly valued, and you could have done 40% in the last year, and that would be a great investing strategy, buying here in panic. But if I look at the P ratio of 33 is a little bit too much for me, and the dividend is not enough. Where would I like to see Starbucks? At a P ratio of 10 and a dividend yield of 6%, which would mean around 30. Will it get there? Probably never, but I just need one in a few years to hit this to make it a buy for me. And that introduces us to the second advantage I have, which is absolute versus relative investing. So absolute investing means I look at the business, imagine that the stock market will close for the next 20 years, 30, 50, and that I just own the business. Would you own Starbucks at the dividend yield of 2%? And that's all you will get from it for the next 20 years. Yes, it might likely grow, but without the market, you need to do absolute investing. Relative investing, okay, now it's overvalued, undervalued, the game everyone else is playing. But if you focus on absolute investing, everything becomes easier. So I'm just looking here at the S&P 500, going towards the 100 soon, and most of them are overvalued because they are in the market relative, and everyone is looking, oh, this could be good now, this could be all in relation to other companies. No, I want, as I said, stocks that have a P ratio of 11, dividend yield of 6%, and offer me 7% growth like Starbucks does. Maybe there was one chance for Starbucks here and here for that, and that is it. The rest was, of course, a growth stock, and of course, yes, it did greatly, but I did greatly too without taking this risk. If Starbucks slows down in growth, the P ratio becomes 15, and then you have to claw your way back from 50% down, which is not something I want. With a great business, with a 5-6% dividend yield and 5% growth, I get to my 10-15% per year without risking this 50%. That's what I'm looking for. And as I said, that's what I have in my portfolio now. You can check my research platform in the link in the description below. I have one good dividend payer, one cyclical. When the cycle turns, we are talking P ratio of 2, 3, not 30. And one with a free cash flow yield of 20%, all spent in buyback. So if you research, you will find those. You just need a few. As I said, I have 3 in my portfolio now. So investing is about the risk and reward of investing, not about outperforming the market in the short term. I don't care about how I perform versus the market in the short term, in a year. And yes, I know I will lose subscribers if I don't outperform the market in a year. But in the long term, the real subscribers will learn, okay, we are here for the long-term investing game, not for competing with everyone else. And Lorenzo here is completely correct. He follows me for 5 years, and it's unbelievable how every stock looks overvalued to me. Yes, most of them. I just own 3, not 300. You almost never, that makes me proud, almost never take a position on whether a stock could outperform the market, because I don't care about that, as said. You keep looking at price earnings. Yes, earnings and dividends are what drives investment returns, not speculative returns. And my assumptions are fundamentally wrong. In your videos, you focus mainly on the balance sheet income. statement, etc., without giving any qualitative opinion on the evolution of the business. Yes, I focus on the qualitative, but I first have to like the balance sheet and the income statement, and then we can focus on the qualitative. You keep saying that some stocks are overvalued, at the same time they keep hitting all-time highs. I suggest you look at more qualitative aspects of a company and focus on those, and then we'll be able to grow for a long, long time. Best of luck. So, completely different strategy from mine, which makes me proud. 99% of the population out there has to disagree with me when it comes to investing. If that is so, I will keep doing well, like I have been doing for the past 21, closing in 22 years now. Let's discuss Lorenzo. Of course, if you look at Apple, quality company, great performance over the last 10 years. I think it is a 10x. So nothing wrong with that, qualitative, and in my eyes it was overvalued, and now it is extremely overvalued, but it just delivered there. And Lorenzo says, Sven, you missed on Apple over the last few years, which makes your strategy wrong. No, I make money in a different way. And if you look at Seeking Alpha, March 30, 2016, Apple for the next years, this young smiling guy here, much younger than me now, wrote how Apple is a buy, price at publication 27, since then 600% up, the S&P is just up 103, the P ratio for Apple then was 10, and you were buying a great business at a P ratio of 10. So I'm just waiting for those. Now, at a P ratio of 30, now it's simply too risky. Yes, great performance, but let me give you the key qualitative factor that delivered the great return here for Apple. Do you think it's phones? No. Do you think it's something else? Tim Cook being so smart? No. The key factor here is that the P ratio went from 10 to 30 because the market suddenly starts to look at those qualitative aspects. When there are no quantitative aspects to push the stock higher, everyone is focused on the qualitative. For me, great, do your thing. For me, it's just too risky because without the support of somebody, this would not have happened. And the biggest qualitative factor here is this one. The Fed's balance sheet went from under $1 trillion to now almost 9 trillion, and they cannot lower it. So they tried here, they started before the pandemic increasing it, tried here, banks, blah, blah. So this is the financial injection pushed the P ratio from 10 to 30. If that ever reverts, Apple is down 66% negative. That's a risk I don't like. But if Apple would be trading at a P ratio of 10 with a dividend yield of 4%, strong buybacks, much more benefits from buybacks, I would surely put it into my portfolio. Maybe it will happen once in 20 years, but that's enough for me. And if you now make money on this qualitative, I'm very, very happy for you. It's just a different strategy. You take, in my opinion, too much risk for me, and that's the difference. Of course, I can underperform for 5 years, but I'll keep compounding my dividends, my earnings, slow and steady, and my only goal is to just keep on compounding. And if this happens, you don't compound anymore. That's why I don't like that strategy of just looking at qualitative, don't care about the P ratio. I've been in the game for 22 years, and I've learned that many, unfortunately, have lost a lot of money by just looking at the qualitative factors in the game. Cathy Wood being the last of the examples, I think. So, to summarize, I don't have to play if I don't like the terms. If the terms are not in line with my conditions, I simply say no, see you sometimes else. So that's something very difficult. If you are in that Wall Street game, analysts, this and that. Everyone is playing that Wall Street game to get rich fast, but you don't want them to get rich on your money, and therefore, if you don't like the terms, you simply don't have to play. That's something very important to understand. Few understand, but I think it's a great advantage if you have it. Absolute versus relative investing. Absolute investing means forgetting about the market. You buy a house, you rent it out, you focus on the rent yield. If you're happy with the rent yield, you're an absolute investor. If you focus on prices going up, you are a speculator. You will likely lose money sooner or later. And then number three, we first focus on risk as value investments, and we try to find low risk and high reward situations. Most situations in the market are high risk, high reward, or medium, or even low. We try to find the opposite, and until we don't find it, again, I don't have to play. Thanks for watching. Check my research platform to see what I do. Saves you a lot of time. You can focus on other things in life. Enjoy life, work, make money, invest that money into value investing, and compound for decades. I'll see you in the next video.